And now, so we're going to head into venture capital. We have Michael Wang. He is the CEO of Telecare. Next, we have Ben Armstrong, the numbers person behind Archangel. And last but not least, we have Samar, who's from Scale Investors.
You should only invest in women-led teams. So women-led teams are 35% higher return, 10% more cumulative revenue. They exit quicker and they're 2/3 more capital efficient.
When we're investing, there's really not much to look at, right? There's people, there's a pitch deck, they're making grand promises how they're going to change the world. What our job is to filter through that and say, these people, they're genuine, they're doing something valuable, it's going to be a good business, but is it a venture business?
You either grow fast or you die fast. Because if you're not growing fast, then you're wasting your time. You might as well do something else.
All right. Welcome back, everyone. And now, so we're going to head into sort of the topic of venture capital. We touched a bit about it in the angel investing sort of session, but in this session, we actually get two venture capitalists here with us. And we also have, so I'll go from my immediate right. So we have Michael Wang. He is the CEO of Telecare, and he represents the startup perspective. And next, we have Ben Armstrong, the numbers person behind Archangel. And last but not least, we have Samar, who's from Scale Investors. All right. I've given the one sentence introduction, but perhaps we'll start from you, Samar. Let's give us the long form introduction about who you are, what you do, and what Scale does.
Okay, firstly, it's such an honor to be here today amongst some incredible professionals that we work alongside quite a bit. And B, thanks so much for the opportunity. I'm going to talk about a little bit about where we came from, how long we've been in market, our thesis and what makes our thesis quite unique, and then also a key focus area and a little bit about where we're at for now. So we are Scale Investors. We've been around for over a decade. We invest into women-led startups. And there are two main reasons for that. Actually, Ed mentioned it earlier, so that was quite good. We've had incredible history as an angel network. We are the first angel network that has been in Australia for over 12 years. We have had a 38 times exit in under 4 years, a 5 times exit and a listing on the NASDAQ. We've invested into 50 companies over that duration. I joined the business about 7 years ago, and two of my business partners took over in a management buyout 2.5 years ago, and 5 years ago we transitioned it from a non-profit organization or transformed it to a for-purpose for-profit organization because of the incredible opportunity. And that is the second part, which is the arbitrage, if you like, of what we're taking advantage of in the thesis. So there are two main components of that. And the first part is maybe some of you know, maybe some of you don't, but women-led VCs only receive 2 to 4% of global capital venture funding. If you're a mixed team, you may be getting 18%. But importantly, if they do raise capital, they're raising 3 to 4 times less than their male counterparts. And Rain talked about this earlier. So when they just really can't get to that Series A where most of VC comes in. And that is the gap that we're aiming to fill and that we've proven, despite their outperformance capability. So women-led teams are 35% more higher return, they 10% more cumulative revenue, they exit quicker, and they're 2/3 more capital efficient. That last one is probably forced. Imagine if you actually gave them the right amount of capital. I mean, I don't know how many times Canva was mentioned today. If I was a VC, which I clearly am, you should only invest in women-led teams. Clearly one of the best performing tech companies has come out of this country, arguably. And that is really the opportunity, I guess, that we see. The second part of the thesis is this lived experience thesis or concept. So rather than kind of wallowing in the investment gender gap, which you hear a lot about and you read a lot about in headlines, we see it as the biggest innovation gap. So, many professionals in this room know that clinical trials didn't include women's bodies until the 90s. It therefore presents the biggest, we think, opportunity as it relates to, I guess, that underlying category of health tech, which is one of our kind of key focus, or care tech, which is one of the key focus areas that we have. And so we refer to that as the innovation gap. which is present because the engineers, the scientists, and the technologists have predominantly been a very homogenous small group of people that look not like me, and they're starting to look a lot more like me and different folks in the room, and that's really what we're wanting to take advantage of. And so that lived experience opens up also a huge female economy. So feeding into the unique perspective of women's lived experience that goes into the innovation gap or fills that innovation gap and services markets which are the female economy, which are equivalent to China and India combined. So they're huge. 52% of the population, women are making the majority of decisions when it comes to discretionary spending and care decisions, which leads me to my last point. 85% of care decisions are made by women, and care tech is one of our key focus areas. We're agnostic at the top line because we actually see great innovations across the investment spectrum, but we're very interested in care tech. So that covers a very broad subset of health tech, med tech, disability, aging, all the sectors of femtech, of course, and that's something that really, really excites us. And we're seeing a lot of innovation and technologies in that space, and we've invested quite extensively already through the syndicate, and we intend to continue to do that through the fund. And then just a little bit about where we're at. So we've raised just shy of 35 million to date. As Ed mentioned earlier, we have the Forrest family on board. We have Breakthrough Victoria and Zampati family, which make up our 3 anchors, as well as a host of smaller family offices and high net wealth and maybe some medical angels folks at some point. So that's just a little bit about where we're at, and thanks again for the opportunity.
Yeah, that's a remarkable, very fascinating so far. Ben.
Cool. So you've already heard the marketing version of what Archangel Ventures does, but I'm happy to give you the more numbers-driven version. But just a little bit about my background. I've done a whole bunch of different things in my career. For a period of time, I helped Telstra develop its e-health strategy, which then became Telstra Health, which is where I've met some of the people in this room. Of 4 of the members of my family are medical practitioners. So, I know and care a lot about this space, which is why we've made a number of investments in healthcare in general. We are a generalist investor. We don't just specialize in healthcare. We were early to the AI trend, which was great for us and our investors. We managed a 7 times return in one of our early plays there, but we do other things as well. Like Rain led us into an interesting opportunity in Web3 when that was actually a thing, and we made over 70 times our money on that, which is nice when it happens. So we're looking at general opportunities. We're looking at sort of diversification through the fund. Both Rain and I have a lot of experience as angel investors. I think between us, we've probably made 300 plus investments. So when people were talking about that's their own experience, same with us, like putting too much money in the first few things, when in fact, like diversification has worked a lot better for me. And you learn a lot from experience. And thank you, those who supported us in our first fund. We're about to raise our second. So for those interested, just have a look at the website. Happy to talk to you or send you some material as well. And we're lucky enough to have a few well-performing companies in our portfolio already. Heidi's been mentioned before. There is an expression of interest for that if anyone's interested. I can influence whether or not or at least advocate for you in terms of whether or not you're likely to be accepted, and that's through our efforts, but also MedAngel's support over the years, which puts us in a great position to be able to do that. So thank you, everyone, and happy to answer some questions later.
Yeah, I think for that, just mention medical angels in that expression of interest form. All right, last but not least, Michael.
Hey everyone, I'm Michael. I'm the CEO and co-founder of Telecare. We're a women-led startup as well, because I founded the business with my wife and she runs me. But Telecare was founded about 6 years ago, 6 months before COVID. We're now Australia's largest virtual specialist operator. So we provide virtual specialist services, physician, surgical specialists to public hospitals, large enterprise like Medibank, the prison system, Department of Veteran Affairs, really large enterprise of government contracts all around Australia, mainly in regional Australia, where obviously there's a shortage of specialist workforce. We've built out a lot of technology to increase the efficiency and the effectiveness of that. So we have standalone SaaS products such as RxPad, like Australia's only cloud native, mobile native e-scripting platform, which just integrated with eHealth recently here in New South Wales. The story, B was one of our early backers, and if you've been following kind of the startup news in Australia, we recently were acquired by Teladoc, the largest digital healthcare company out of New York. They're listed on the New York Stock Exchange. So I suppose, I've gone through the process of founding a business, growing it to more than, $10 million in terms of annual revenue, and then going through that exit process as well. I'm still the CEO and the director of the business, and I will stay with the business probably for the next few years and make sure that, it goes well. So I'm happy to kind of talk about my journey and the insights that I've learned kind of through that journey as a founder.
Yeah, beautiful. So we've got quite a diverse sort of audience as well as our panelists here. So I guess, what do you see as sort of your challenges in sort of venture right now today? And I guess also play off with, having a founder over here to double check you guys on that.
I think, unlike Rain, it took us a while to raise capital, and I'm pretty sure it did for them too, but he's a good marketer. I think raising capital from folks is definitely it's always the biggest challenge. I think all the veterans in this space have told me it's probably been the hardest time to raise capital. And I just think that means that we then therefore miss out on innovation. I think Amandeep was saying it earlier. The amount, the natural evolution of every single angel network, Archangels, Scale, MedAngels, is to move into funds management. And the reason for that is pace, professionalism, and really sophistication in picking, I guess, the best winners. But you need to do it at volume and you need to do it at pace. And I think one of the biggest challenges is how many investments can you get into and how quickly can you do that? And I think, JP talked about this yesterday. So the pain report guy, who was very great and performative. I believe we're at the cusp of the next kind of revolution or technological step change with AI. And so, every single other step, so the internet, the mobile, the biggest companies were formulated within the first 5 years after those. And I think that's that's kind of the timing, I guess, that we're in. If you believe that, that is the next kind of phase. So it poses a challenge on which investments do you make, who do you choose to back as either founders or a fund manager. And I actually think it's therefore the biggest, it excites me immensely. I think it's super exciting. It's the best time, I think, to be in this position. And if you can get access, I think this is the time to do that.
Cool. So I agree with that. But probably the hardest thing for me is getting the people side right. So whether it's the people in the team, like our team, and we're fortunate now to have a great team, so I don't have too much to worry about there. But the people that we back. And so a few people have said this, but when we are investing, there's really not much to look at, right? There's people, there's a pitch deck, they're making grand promises how they're going to change the world. And what our job is to filter through that and say, these people, they're genuine, they're doing something valuable, it's going to be a good business, but is it a venture business? And there's so many businesses that we see that's great, I love what you're doing. I wish you the best of success. I know you're going to make a big impact, but it's not a big enough impact. So we're always looking for that company that is doing something that has global applicability, not just in Australia. We're looking at something that, some of the presentations earlier today, we're talking about, billion-dollar markets. That's great. But we're also looking for things that go incredibly fast. So that's the sort of risk-reward equation in venture. We're, as a fund, and probably you're similar, we're looking to make a 20 to 25% IRR every year, right? And that's hard. that's above like a lot of public market stuff. It's above like a lot of stock market performance. And to do that, you need outliers. And so we're always searching for those unicorns, to circle back on that kind of concept, but also that get there reasonably quickly, because the cost of, as time progresses, if it's taking longer and longer to get that exit and longer to get that value extracted, your returns are going down during that period of time. So that's the biggest challenge from my point of view.
Yeah, awesome. And Michael, you know, through your journey, you were interacted with lots of VC, and where do you see that? You know, what are the challenges there?
Yeah, so this is really interesting. I've never been on a panel with like the investors. Usually I'm pitching to these guys and I'm asking them for money. So it's like I'm down here and they're up here and I'm like, can I have some more? I guess from my perspective, I was looking at the investor. You know, most of everyone here, you guys are all physicians, clinicians, you know, in the medical field. As a founder, for myself, I think team is one of the most important things. So I suppose reflecting on as from the investors, I think generally when you look at an investment, team is what you should look at, because there are many good ideas, and unfortunately, as a startup gets, you know, a little bit of traction, those ideas become public, and other companies, including larger companies, especially in healthcare, are going to leverage their advantage to try to take, you know, take those ideas and replicate them. I mean, that's something that, you know, we experience where, you know, you've got the big players like Bupa, like Medibank, like all these large players. They try to replicate our model, our technology, and they try to bring it to market, because obviously they have a large base of patients and clinicians already working for them. So they've got a big advantages that we don't have. So as a startup, you really rely on a strong team to execute faster than your competitors. Investing in the medical field, obviously health tech or biotech, you're really playing in the most highly credentialed, highly governed industry there is, because it is so risky, right? But as I suppose clinicians yourself as well, you guys have insight into an industry which other people don't have. So I think you should really leverage that understanding. So I am the CEO and the founder, my wife and I, Lena and I, but I also have two other co-founders who are doctors, Dr. Chrissy and Dr. Raymond Wen. Chrissy is a nephrologist who's recently the head of nephrology at the Alfred Hospital, and Ray is he's a GP owner and sits on a few kind of governing boards. So I really relied on them to provide me the insight and the understanding of how we should navigate, how we should clinically govern our services, even things like how we should build our user interface when it comes to software. And I think that from there, and I think I'm speaking on behalf of B here, but I think that's why Medical Angels chose to invest in us as well, because, you know, B's a doctor himself, and he looked at our software, looked at our platforms, and it's really the insight which drove. He's like, hey, this could work, right? This could work. I can see it working. I can see it scaling. So I think, you know, as everyone here, potentially being an investor in the future and also a clinician, I think really leverage that insight you have. You know, it's good to look at numbers. It's good to look at reports. It's good to look at addressable market size, you know, go to market, you know, all the high level, the pretty pitch deck. But at the end of the day, I think you should just look at what you know and be like, does this work in my field? If it's a product or a technology, I'm going to talk to my friend. I'm going to talk to my dermatologist friend, my ENT surgeon, my you know, rheumatologist friend, right? Like, will this work? And then ask them, you know, hey, if a product like this were to go to market, how do you see it working? Who's going to buy it? How much are they willing to pay for it? How much time does it save you? And really kind of understand, because that's really, I think, an advantage which, you know, as people who work in the industry, that no one else is going to have. Like even you know, the top tier investors, they're not going to have the amount of insight that you guys do.
All right, I'm gonna get back on you on that one. But Ben, you mentioned earlier that some companies are not venture scale. What is venture scale?
Okay, so venture scale is the concept that, you know, you're going to grow like exponentially, not necessarily linearly, and you're going to do it over a increasingly short period of time, if all these companies that are scaling using AI are. And like when I started in venture, which is a fairly long time ago now, like the theory was, you know, in 7 years you could get to about $1 billion valuation. These days we're seeing companies do it in 1 or 2 years. And how are they doing that? They're just signing up an outrageous number of customers in a very short period of time. So back to Samar's point, it's a shift in the technology that's enabling things that weren't possible before, and those are the kinds of things that we're looking at. And so that's always changing, which is one of the benefits of investing in a fund, because we have a longer time frame, we can work out what the changes of technology are, etc. But it's really looking for those sort of hyper growth companies that aren't just going to be a good outcome for the founders, but be a good outcome for the investors, because it's doing something now that everyone wants to have, and they're going to pay a premium to either take that company out, or when it lists, it's going to raise a whole lot of money, and its valuation is increasing. Hopefully, initially 3 or 4 times year on year, then going down to maybe 2 or 3 times year on year, etc. So it's rapid growth. It's not 10, 20, 30, 40% year on year. We're talking 400, 300, those kinds of things. And then the outliers are really thousands of times. At peak Heidi, it was growing at over 8,000% year on year, which was great. And that's what you want to see. And you want it to continue as long as possible.
Samar, is that your definition of venture scale?
Yeah, I mean, I guess, you're really looking for accelerated growth in a very short time frame. I think the only thing I would add is, I think it's why a lot of successful angel networks become funds, because they have the hindsight of having invested 2 or 3 times as an angel network and then going, oh, we can put this in the fund because we know the trajectory. So we sort of have that insight. But I guess I do think about it slightly differently sometimes as well, is that if you exit in a shorter time frame, you can still get the multiple at the end of the day. It's maths, right? So we also think about that from that perspective as well. So, a technology that can be built in Australia and can show significant scale, but Australia is too small. It's just not going to have, but the cost of going into another market may mean you can exit at that time. Or as Ed said right at the start, we can take a little bit off the table, create a bit of a secondaries liquidity event, show some money back to our investors, and then hold on and then get the full upside. And then that works from an economics point of view for the fund as well. So I think that what this environment has also posed is a really great opportunity to do those types of things, because the Australian market has matured quite a bit in the last decade, whereas, a decade or so ago, it's actually not relevant and just not available to us at all. Whereas now you're seeing that opportunity to go into global markets. And I think the only other thing I would add is when you're looking at a direct-to-consumer model, which is something that we consider as well, and I think something that smaller VCs probably consider more so now than what they did. So it's not everything has to be B2B SaaS, boring. That way, what you're doing is also taking advantage of the region. I think JP talked about this yesterday, about going into the ASEAN region, and there's so much investment going in there from the government point of view as well, which I think is an advantage for VCs looking at alternative models and what AI actually enables you to do as well, and create that exponential growth into different markets that are not only the US or the UK. You can actually go into our neighbors here in the region and make a significant amount of capital or growth. Particularly user growth is what we're seeing in some of our portfolio companies, landing in Vietnam, landing in Indonesia, and just seeing exponential growth in those regions as well.
Yeah, good point. Michael, you've obviously pitched to a lot of VCs in your time, and thankfully you don't need to do that anymore because you've been acquired. Give us some of your war stories, or what some of the feedback
I pitched to
was.
Ben.
I said no. I said no a few times.
I mean, I think you can share why you said no, because I led the question with what is venture scale, right?
Okay, so I love Michael, and Lena is and actually a few of the team members I knew from before. So I knew they're all very good people, and I know that there's a problem in medical support in hospitals and other environments and getting access to specialists. 100%, total believer. And then I was looking at the market dynamics in general, and I know what it takes to be successful. And a lot of it's sales-driven influencing of people, at the right level to make a systemic change. And that's tough. And I knew it was going to be a bit of work, but I could see the value of locking those kinds of customers in. What I couldn't see is like what was going to drive rapid adoption. Like it's a regulated area, slow decision makers, and also like who's going to acquire it. So can I just go on a bit of a side story for a second? So when I helped when I was at Archangel Ventures and we're looking at healthcare, like we made a number of investments, including in Health Engine, which has done quite well. A lot of the things that the management didn't want to look at is anything to do with things that were actually in the provision of healthcare. So they didn't want to be medically responsible for anything. So they were very happy to do digital kind of health things, but they didn't want to do something that might see their name in the paper because someone had died or there'd been an adverse outcome or something like that. And I think that's an example of where everyone in this room has a potential advantage. And we're seeing it actually with some of our health portfolio as well. Like it's not just a bit of digital health. It's not just like telehealth. It's also like that need for the physical element. And that's an example of a care model that I think is, I mean, not totally revolutionary, but the tools are now there. You can reduce the cost of care to the patient. You can, and the system, you can have more personalized healthcare because you can always get 24 support of some description, and you've got more of a whole patient journey across the way. So like we've done one that does ADHD care called Kantoko. We've done another one called One MRI that you might have seen that's in sort of full body MRI. And a lot of the doctors that we talk to, because we've got a few in our network, a lot of them are fairly dismissive of some of these models because part of it involves like disruption. So that's the other element of what we're looking at. Like we like to have friends, but we're also looking for the pressure points where you can disrupt an industry and really make a positive change in a way that perhaps others haven't felt confident that they can do. So, we don't have sort of a vested interest that we have to support. Like we're happy to go in there and support these founders who are like, that's how the health system works today. That's how, we can make money. However, like we think there's another approach that's just as good or better, but is different. And so, that's, if we can find those disruptive things, that's great. Going back to Michael, evolutionary, absolutely, impactful, absolutely, somewhat revolutionary, but not disruptive.
I think I agree with you, Ben. I think when we founded the business, as part of the core principle, this is the first business I founded. So we looked at a problem, which was, Australia's population of, at the time, 25 million, 35% of those people live in regional areas. 90% of specialist doctors and surgeons live in, Sydney and Melbourne, really. Addressable market size, absolutely huge. And, locum services, which I'm sure everyone's familiar with, just simply aren't reliable. So that was the problem. We saw the market size, but the problems which Ben highlighted, and this was early stage, relatively early, we didn't understand that. So for me, it was just like, I needed to found a business. The problem was there. The market size was there. The potential was huge. But then all the kind of things that Ben raised were the barriers that came up. And that was for us as a team, as a company, to solve. And we eventually obviously conquered those barriers and scaled up. And now we're still kind of growing and growing. But I can see it from Ben's point of view where, they're like, great business, great addressable market, but you've got these barriers where like, well, how are you going to cross them, right? You're not a B2C. It's not like you can trade investment money for Facebook advertising. You can pump revenue and then you can raise another round and raise because, as you all know, most startups run at a loss, right? It's a burn phase, then eventually over 3 years, and it's about pumping the valuation of the business. Before us, we were, pretty much break even after the first 12 months. So we were a different business model. We were, one of the businesses which may been, was a good business. It worked as a possibility, but was it a venture scale business? And looking back right now, I suppose, are we a venture scale business? I think building a health tech or a med tech business, if you're going really into high compliance, which is high compliance, high governance, high credentialing, things like that, it's very, very difficult to do the 7,000, 8,000% a year, because it's almost oxymoronic, especially if you're providing care. Because you guys all work in, how long does it take to get credentialed at a public hospital? Like if you're working on these kind of relatively large bureaucratic systems, it's going to take a lot of time. For med tech, what's the stages between phase 1 and phase 2 clinical trials? So you're really your 8,000%, your 9,000%. These businesses are really going to be direct to consumer, or they're going to be B2B. And even B2B is a little bit, because the sales cycles are anywhere between 3, 6, 12 months to do the sales cycles. So again, from our point of view, we always knew that if we could crack those problems Ben was talking about, we would be an attractive acquisition, because funnily enough, you helped found Telstra Health. Like one of our first hospital contracts, it was Telstra Health gave that to us, because they, like you said, they didn't want to do the clinical care anymore. But at that time, we had already solved we had built out the technology, the process, the innovation. And from our perspective, and why we became an acquisition, is that through the process of this kind of slow and steady, we grew, we're growing anywhere between 70 to 100% a year, and we still are growing at 70%, 100 a year. So it's not the thousands of percent, but through that, we're able to gain the insight and really build a moat for ourselves, and then be a relatively strong business. And that ultimately made us an attractive acquisition for a larger company, which kind of saw us and like, I could purchase this company, or we could do it ourselves and potentially fail. So this is why, in terms of us, we were a little bit different from maybe the standard kind of startup, which was just hyper growth, and then raise money, put the raised money into advertising, marketing, and grow revenue to do further rounds. The idea for us was to kind of establish a reliable business, scalable business, and take the advantages of the insight that we have and build on that, and hopefully sell it off, which we did.
I mean, it's super hard to predict what businesses at the very early stage are going to exhibit those characteristics. But that's the challenge, right? That's what we're all dealing with. And I have no doubt that when Michael eventually founds his next company, he's going to have solved so many more of these issues, and it's going to be a much bigger returner. So one to watch.
Pitch you the next one.
We'll have a check available. All right. So now, a lot of, both Samar and Ben, you guys were sort of angel investors before you got into the venture space. I think some of us are seeing, the differences, but, perhaps say in your own words, what's the difference, and what does it mean to go from that angel investor to become a venture fund?
Yeah, I think the biggest difference, and the way I describe it a lot, is angel investing, especially from a manager point of view, is like raising a fund every single time you do a deal, because you're literally finding the best people to match with the opportunity at any given time. So we've had thousands of folks come through our doors over the years, and it depends on who's part of the syndicate at that point in time, who's interested, who has money, who hasn't blown it all at the start, which we all are guilty of doing, and really matchmaking. So essentially doing a deal. It's deal by deal every single time you do a angel network. It's also really hard to lead deals when you're an angel syndicate as well, because it's typically sort of, as I mentioned, pooled. You're pooling money together, so it's harder to get to be able to commit to a check size for a founder. So that makes it really hard for them. So usually last check in, because you don't want to muck them around and be like, oh, I think I might be able to get 50, and I got an expression of interest of 100, and then everyone pulled out. You can't provide that certainty, I guess, from a founder point of view and from a deal point of view as well. And then I think the other thing is it's usually very emotional for each investor that you're dealing with, in terms of why they're actually investing. And I guess we've always tried to do, and I think the key difference for a fund is there is fund economics at play, which Ben has talked about quite a bit. And so, the deal terms become far more relevant, but that's also a really, I guess it's a pro of being an angel investor, is deal terms on a deal by deal basis are less relevant to you than as a fund manager, because sometimes then we might see a really great deal for the fund that we're looking at the moment, but it just doesn't fit in with the economics, whether it's time frame, whether it's valuation, whether it's check size, and our exposure. And there's a whole bunch of kind of, maths things that we need to consider as it comes to like portfolio construction theory and what we talked about yesterday, which is, more portfolio theory and diversification, and how much exposure we want to have to one sector versus another, depending on what we're predicting through our glass book, our what is that? Our foresight, which we, pretend we think we have, but it's hard. And it's mostly based on, obviously, I think Amandeep mentioned this earlier, is having relationships with founders for a really long time. So they're probably the key differences that I see. I'm sure there's plenty of more that Ben could cover as well.
Yeah, no, I agree with that. So I really like angel investing, and I still do a bit of it myself, but it is very, and it can be like, it depends how you treat it, but like, as long as all the points that were mentioned before on the previous panel, like you have a budget, like you work out how many investments you want to make out of that budget over what time frame, like I think that's a great way of learning. But if you want to take it seriously enough and you want to get the returns, you could be incredibly lucky and get it right first go, but like that's unusual. So you've got to expect to be at it for a while and put in the time. Not many of us have that time. So that's where a sort of fund becomes sort of a better model, and actually probably quite a few of us like invest in funds, maybe operate funds and invest as an angel. One of the benefits of angel checks is often you can get an education about an industry. So like I'll do like angel checks in US based companies, which is my way of educating myself perhaps on the market 6-9 months before that same idea pops up in Australia. And I find that useful. Some of my successes has been in markets that I'd never have access to. I've got one in Morocco. It's like I'd never invest in a company in Morocco myself, but like if there's an angel opportunity, maybe that makes sense. And then, I think it's good to have a platform that surfaces enough angel ideas that you're actually getting some good ideas, because pretty much you can guarantee the people in your immediate network, there might be 1 or 2 outliers, but you're only seeing a tiny percentage of the market and probably not the best deals. Like that's the challenge. You need to see a lot of things to pick and learn what's good. Whereas if you're investing in a fund, it's more hands-off, you're sort of trusting them you can still be helpful. And I think, both Samar and myself, would love people to lean in more and help the portfolio companies that we have. Like it's a great chance to influence the outcome. So it's not totally dissimilar to writing an angel check, but you don't have to manage them long-term, which is probably good if you're busy.
All right. And I guess one of the questions is that we're talking about all these different asset classes, these spaces we can invest in. Like, where does venture sort of fit into a typical portfolio? And, how much should you put in it?
All of it. No. The debate no one ever asked for.
Yeah, it's sort of awkward, but it's good to have the conversation. So people say the standard theory is like put 10% of your net worth into alternatives, right? And VC is in that alternatives bucket.
I think it's 50.
Sure. Do I hear 20?
I mean, it depends on your risk appetite and risk profile, which is just your time frame. Like, how old are you? When do you think we have very interesting conversations with some.
Yeah. So some of us have a lot more than 10% of their net worth in this asset class. And, I guess if you're getting the returns then and you're enjoying it, then why not, right? That's just a standard sort of blanket statement. People lose money in all kinds of asset classes, in property, maybe there's fraud, there's a whole history of property funds that have blown up, for example. And you think property is a reasonably like safe asset class. So I won't pick anyone else out from that the broader asset class, but there's underperforming managers across the board. Maybe it's your super fund, who knows? So you really want to have a diversified portfolio, and the part that we're focused on is that high growth, high risk, high reward category. So if we can't deliver you high growth at high risk, then we're failing you. But so that's
Yeah,
probably
I think the way that I think about it is like if you bring it back to modern portfolio theory that was discussed yesterday, it's up to it fits in within an alternative asset bucket. Angel and VCs are different within those buckets, so it's not the full allocation. And then I also think about it as if the manager or the deal that you're doing in that alternative asset bucket, which is not just venture and angel, by the way. If that ideally, the way that we are kind of selling the dream, I guess, is we should return your entire portfolio by the time we're done. And if we don't, then that's not top performing venture. And that's really how we kind of see it. And as well, you're getting access to innovation that should, in effect, influence and the decisions you make across your entire portfolio. So, it's an opportunity to get really hands-on. We're very lucky to have the 3 anchors I mentioned, and a lot of our LPs are actually strategic and they want to come in and support, and we love that. And you don't have to, but it's something that I think is really quite unique to angel networks that transition, including med angels, to funds.
Yeah, it's also like our asset class isn't really correlated with public markets or anything else. So it's like quite distinct. So like they could be way down and we might be up, and maybe vice versa. But like the whole idea is that, you're getting you're getting access to a different asset class. You're getting in very early when the chances are that it could become, much greater. And if you have the inclination, you can actually like help these founders on the journey. So you actually have a chance to influence it. Like if you invest in a listed company, what's your chance of influencing the outcome of that company's trajectory? I don't know. Depends on how big they are, perhaps.
And like Rain said, don't bother us or the founders if you're not getting your money back soon. It's a lockup. You just need to understand that as well, I think, is a really important factor for this asset class.
And lastly, because we have a recently exited founder who now is swimming in cash, have you given a thought about how much you would allocate or done any of that
It's
yourself?
only been 2 months.
Is this reverse pitch time?
All right, my turn.
Sorry, but
Because I founded a startup, for me to invest, I might do a case by case basis, because I've looking introspectively and from a bottom up perspective, I would be looking for similar traits that my team and we displayed during certain points where the business is not going so well. So I might go out and look at businesses, and I might look at the businesses, and then go, hey, because what I'm saying is, and this sounds really arrogant, I'm saying that because I founded a business, I should be able to pick the winners because I know what it takes to be a founder. But funds are a little bit different because you would be relying on the fund to pick the winners, I suppose. But I've kind of, as doctors, you probably, when you go see a medical practitioner, you're like, oh, maybe I should suss this guy out or ask my friends or, look at the medicine, look at it because you have the insight. Well, that's kind of what I'm saying. So, and I think I would always recommend that kind of pub test. And it kind of echoes on my first point. Like if you guys are going to invest in med tech, health tech, like, in the industry, you guys can suss it out. Like, just have a look at it. Or, go through, talk to B, talk to your friends and like, look at the product, ask executional questions. Because again, I don't look at things from top down because I had to build everything from the bottom up. So my perspective is a little bit different. So for me, start investing, I would look at a business. I'm like, well, what do I know about the industry? What do I know? Like, and then it would be an interview process where I could invest in anything. And through the pitch deck, through talking to the founders, through kind of this process, it would be their investment to lose rather than win. Because obviously every pitch deck is like, oh, we have like a, $10 billion market size. We're going to do this, we're going to do that. I'm like, oh, how are you going to do it? How are you going to go to market? Who are your users? What kind of traction do you have right now? If I'm Doctor, pitch me the product. Can I see myself buying this? What is the price point? I can really go into deeply the executional. What is the process? What's your marketing plan? Like what's your key messaging? What's your strategy? How are you going to build a team? These are the questions that I would be asking because I've done it myself, and they're the problems which I had to cross. And in terms of understanding that insight and those problems, I think it's that bottom up executional process which I would be looking at. So that's my personal answer. I would be looking at each business individually and forming an opinion on it.
Sounds like we all need to pitch you at some stage. All right. Now, I think one of the other things that make venture so attractive is the structure and the tax incentives. You want to...
This is not tax advice. I think there are a few people yesterday that can help you with that. But it was mentioned earlier on the angel panel, I believe. But I believe the three funds, so MedAngels, us, and Archangels, have set up an early stage venture capital limited partnership, ESVCLP, which is a federal government structure that's come out of the ATO, which essentially gives you 0 CGT, so no capital gains on any. Obviously, as long as we make the returns for you. And I believe it's 10% tax offset every year on deployment for the deployment period, which is typically 5 to 7 years. So it's an extremely attractive structure that's been set up for us to invest into early stage, and all the regulation and making sure we meet that regulation hurdle, it sits with the manager. So that's ours to make sure we do right. And those things are, the valuation needs to be less than 50 million. It needs to be true innovation. It needs to be high growth. Like, there's a whole bunch of things that you submit to the department and say you're going to do, and you just need to make sure you kind of follow that, including like diversification in terms of how many investments you get access to, a whole bunch of things which protect obviously the investor, but also ensures that that money is actually going into Australian innovation. There's also limitations on how much you invest both locally and globally. So you get up to, I think, 20 or 30% to invest globally, and then also accepting international investors as well. So I think we got our first one this week as well. So you can accept global, like foreign investors into the fund. And I mean, really the main reason you would look to do that is obviously if you're going to be expanding into those regions, you probably want to start looking at investing and having some exposure to some extent with investors that you may co-invest with along down the track. So we see it as really supercharging the Australian ecosystem with potential opportunities that then get funded by what we mentioned earlier, which is where the majority of VC in this country come in, which is Series A and beyond.
Yeah. And I think to add on to that, if you're an angel investor, you get access to sort of these, ASIC. Do talk about?
Yes, well, we were an ASIC. Yeah, we were an ASIC company. I went through a couple of accelerators. The StartMate. I think you interviewed me for that, so thank you. But we were ASIC, early stage innovation company, which is similar kind of. So it's no capital gains tax for like 10 years. And then I think it's a 20% offset for an ASIC company. So when you invest, being physicians, probably clinicians, you guys all have, a lot of tax. And I think that's really what secured our first round, because our first round was almost done purely by individual doctors. I have a lot of friends who are doctors, and I was just like, have you heard of the ASIC? I'm starting a business. And they're like, your business sounds crap, but this tax thing sounds amazing. Here's the money. We were an ASIC startup. Like, that was my product. Tax incentives.
That is not the reason.
No, that was a joke, and definitely not financial advice.
You say that as a joke. We have one medical angel investor who, every time we publish a deal, the first question he asks is it ASIC?
We had an angel investor like that too.
So there we go. We still got some time for questions, maybe 10 minutes of questions. So if anyone want to start asking.
Yeah, so I think someone mentioned that you get 10% off the declarable tax for the first 5 to 7 years of the deployable period. Since angel investing has already been around for a few years, does that mean we subtract those years from the 5 to 7 years, or?
So we've done one ESVCLP, so we've dealt with the tax office and others on it. So what it means is if you deploy, like say the venture fund calls $100,000 of your capital in year one, 10% of that, and there's details of it, so it may not be quite 10%, but 10% of that you get to count in that tax year as a deduction against other income. Yeah, that's offset.
So it's not a
so it's offset.
it's an offset. You get that 10% back. So it's not a deduction against your taxable income. It's an offset.
Yeah. So it's better than normal. It's much better than normal, and obviously can result in you getting tax back if other actual cash back if other things are low. So that's how that works. But so that'll be 10% of the total amount, like over the period of the fund, it'll be 10% of the total amount that you have committed and actually paid.
And is that for personal investors, companies, trusts?
Yeah, so it works across the board, is my understanding, because a trust is a see-through entity, so it sort of just flows down. But if you're a personal investor or an SMSF investor, I think that's probably a great structure to use to do it. But I think you can do it in the other entities as well.
Any other questions?
Thanks a lot for those very interesting discussions. I had a question about timeframes. I know we touched upon it just then. Now, a lot of things get thrown out, 30 times, 100 times return in like 2 or 3 years. And you kind of think, all right, this is the perfect get rich quick scheme. But realistically speaking, we heard property shares, we're looking at 5-10 year timeframes. Is this about that in terms of when you're putting together your portfolio, or are we looking 10, 15, 20 years or even longer? I mean, Amazon took 30 years before it turned a profit, etc. But
Yeah, we talk about it as in terms of the fund, like an ESVCLP fund. We talk about it as a 10-year lockup, and that's typically the kind of time frame that you're looking at. It has a 15-year expiry, so you have to get out before then. We need to do that. I think it really depends on each fund manager, though. They will have a different sort of time frame that they're aiming towards. But if you are setting up that structure, it has a total kind of lifespan of that. And so we think about it as, we always say 10-year lockup, but it's 10 plus 2. And the reason it's 2 is because, as I mentioned before, say we're at 35 million, we want to get to at least 50. We get 2 years to continue to raise capital from first close. And so that's why they're typically called like 10 plus 2. And look, I think it just really depends on every single fund, right? So we say that, we always say it's not guaranteed, but because we've made some early investments that we will follow on in or make an initial investment into this fund, we expect to start returning capital or returning the way we talk about it is we want to return your investment before you've deployed it. So within the 5 to 7 years, we want to start returning that capital, but it's not guaranteed. But it's different for literally every single fund. So you need to, unfortunately, that's the work you need to do and work it out. I don't know, Ben, what your time frame is.
Yeah, no, it depends on the assets that you're investing in. Like some people invested in Canva first round. Have they got cash out? Some of them have, because they sold it into to someone else, and so they got that liquidity early. But those people are still hanging on. Maybe it'll list next year if you read the public things. Maybe the year after. I'm not sure, but like that'll be a massive return, and I think those people would be glad to have been locked up that long if it means they're going to make an even bigger return. But there usually are opportunities with secondaries and other things to like get liquidity early if that's what you need. We as soon as we start selling companies or someone buys them or they list or whatever it is, like we start returning that cash. So cash is going out through the capital calls, which is usually about a 5-year period, maybe at the max. And then cash is coming in maybe a little bit early, like Rain was saying, a little bit early from outcomes that are okay but not brilliant. And then it's just really when you're getting liquidity on those like bigger, more successful positions. I can send you some statistics if you want to see them in general.
Hi, thank you so much for sharing your insights. It's really interesting to sort of see things both from the top down and then the bottom up. So my question is probably more directed towards Michael, because I am part of a early startup group myself, and that's sort of slowly cooking, incubating with the Sika Lab at the moment. I mainly wanted to know the relevance and importance of early traction. Like, how long did it take from the inception of the idea and motivation, say, okay, we're going to do this, to actually, getting your first customer? And then, how long did it actually take you to have your first lot of investment? And then how important is it to keep that timeline? Is there a certain timeline? If we're going out more than 12 months, then this is a no-go. Like, do you have any sort of advice on that?
I think traction is key, like for a startup business. I think traction, paid users, is really what gets you from like you're just an idea to what you're a business. So I think and you would agree with this, right, Ben? Because if you go through any startup incubator, if you go through any startup, it's always about traction, it's all about growth. So my general kind of idea on this is that you either grow fast or you die fast. So because if you're not growing fast, then you're wasting your time. You might as well do something else. So just if you can get traction, if you can get paid customers, no matter, and at the start, as a founder, you have a lot of time because you don't have to serve that many customers, because once you grow, a lot of your time is going to be, on customer relationships and account management. So at the start, like if you can make a sale, just spend time with the client, get the sale. If you need a discount, get it. And then the good thing about from your early stage customers, they'll give you a lot of feedback in terms of where your product should be, because they'll ask for the features, they'll ask for the upgrades, they'll ask for the things. So just get those customers, start refining, and as soon as you get $1 worth of paid revenue, chuck that on your pitch deck and be like, we grew like by 7,000% the first year because we started from zero. Now we're at like $700. So yeah, definitely do that.
Okay. Thank you everyone for in the panel. I just want to add one more thing, because the sort of the founders and also funds we have here are very more sort of in that kind of category where it's easy to get first sort of revenue, because it's more sort of I guess direct or more consumerist. But like as you've seen some of our startups earlier, some of them would not have a single dollar revenue until they get the regulatory approval. And a lot of that early stage is spent building the product to get to that sort of takeoff point where they can start generating revenue. So it's I think one of the things we said earlier is that medtech is really hard to do, is just because it's there's a lot of nothing and a lot of burning money until you get to the point where then you can explode. And so it's a different kind of metric, and that's why I guess I exist, and myself and Amandeep exist in this ecosystem. Yeah. But anyway, thank you so much to everyone on the panel, and yeah, we look to working together. This podcast is for educational and entertainment purposes only. The information and opinions shared are not intended as personal financial advice. The content presented should not be relied upon for making financial investment or other decisions. Listeners are strongly encouraged to seek the advice of qualified financial or legal professionals before making any financial decisions. While we aim to provide valuable and accurate information, we make no guarantees regarding the completeness or accuracy of the content. Any reliance on the information provided is done at your own risk.